Welcome to the lecture on delevering and relevering. I want to take 1 minute and talk big picture about where we are before I dive into this new topic. So with delevering and relevering, we're trying to build on discount rates. We've talked a lot about discount rates so far. We want to think about measuring it for a firm. Okay, we've talked about capital structure and we've talked about WACC. We want to build on that and be a little bit more rigorous and precise in how we figure out what a firm's discount rate is. Okay, so what are the things that drive the firm's discount rate? We've talked about a couple of things. We know that the assets are important. If you've got fundamentally risky operations, you're going to have a different discount rate than a firm that has safer operations. Okay, so we know that that's one key driver of a firm's discount rate. But then we've also talked a lot about capital structure in the past couple weeks. We know that a firm's capital structure can affect their discount rates. So this happens through a couple different channels. We know that, for example, more debt makes equity riskier. This was the Modigliani and Miller proposition number 2, right? The more debt you take, the more risk you squeeze into the equity share of the firm, and so the riskier the equity becomes. And then we started thinking about taxes, and we said that interest tax shields are good. Interest tax shields end up lowering the discount rate for a firm because that's valuable for their investors, right? They like to get these tax shields. This benefits the firm, but it also benefits equity holders. Equity holders like tax shields, they can get paid from that as well. So interest tax shields lower the required return for equity holders potentially. What we've done is we've talked about this in kind of generalities. What we need to do next is to put a number on these things, right? We need a rate. We need to have some number. In order to get a rate, we need to take these ideas. We know that these things affect the discount rates. We need to take those ideas and put them into a formula somehow. We need to think about them rigorously to get a number. That's what we're going to do with this next topic on delevering and relevering. Every problem we see is going to have 2 steps. The first step is we're going to focus on the assets of the company. So again, if you pull up the whiteboard, right, we know that the assets are important. Those drive the discount rates. So we're going to delever the company. We're going to get rid of any capital structure effect and just focus on the assets. That's called delevering. Once we learn about the assets, then we think about the second pieces, right? The second piece with capital structure. If we know what's going on with the assets, then we can adjust for the capital structure. And we have to adjust for these 2 things, right? Debt's going to make the equity riskier, but the tax shields are also going to lower the discount rates for the firm and for the equity. So we're going to account for these 2 things when we relever to the firm's capital structure. This 2-step procedure is going to be very helpful in a variety of contexts. First, you can think about the firm changing its capital structure. The company makes a strategic choice to maybe take on more debt. So a lot of tech companies, for example, they won't have any debt to begin with, and then they'll take on debt later on. Well, that's going to change their WACC. That's going to change their discount rates. We need to be able to carefully measure exactly how much is their discount rate going to change. Another place where this is going to be helpful is that it gives us a lot more data to work with. If you're trying to estimate a discount rate for your company, it may be useful to look at other companies as well. Think about other companies that are in similar businesses as what you're interested in. You can use all of that data from those companies to help you get a better idea of what your discount rate should be. So a classic example here is if you have a conglomerate and you've got multiple divisions within your firm, it's hard to learn about the discount rate for each individual division if all you see is your firm. If your firm data is at the firm level, so it's aggregating all of the divisions together, that's not going to help you with any individual division within your firm. So you have to look at other companies that have the same assets as your division and learn from them. Okay. So that's another place where this two-step process, delevering the assets and relevering the capital structure, is going to buy us a lot. The mechanics of this depend on our capital structure. So again, right, capital structure is very important for our discount rates. So we need to know what's going on with this into the future. If your capital structure, for example, stays constant over time, that's going to have one implication for your discount rate. If your capital structure, on the other hand, maybe has a constant level of debt, so instead of having a constant debt to equity ratio, maybe you have just $100 in debt and you just keep it at $100 forever. That's going to have different implications for how you relever your company. Okay, so for now, just have in the back of your mind, it's very important what's going on to the capital structure in the future. It's not just what is the capital structure today, but also what is the capital structure going to look like in the future. That's going to drive your discount rate. We're going to see this in a couple of different models. We're going to see that the delevering and relevering process looks a little bit different if you hold a constant debt to equity ratio than if you have a constant level of debt. Okay, so we'll talk about why that is, but the big picture, what you should have in your mind for now is that the discount rate depends on what's going on to the capital structure in the future. It's not just what happens today, but what's going on in the future as well. When we talked about the weighted average cost of capital, we said that the WACC is making some restrictions. The first restriction is that the capital structure must be stable. So if you pull up the WACC equation here, we've got these ratios, the ratio of equity to the value of the company, the ratio of debt to the value of the company. All right, if these things are changing, your capital structure is changing, then your WACC is going to be changing. We also know that if your capital structure is changing, then equity, the discount rate on the equity is going to be changing through Modigliani-Miller number 2 and through these tax shields. Okay, so the point is, if your WACC is changing, you've got to be very careful in how you measure these differences in the discount rates. We also know that when we want to use the WACC, we're getting one number for the entire company. So if you want to discount something using the WACC, that project better look like the rest of the company. A short way of saying this is that the project must be a carbon copy of the firm. Right? It's got to look pretty much identical. It has to look identical on both the asset side. Right? We go back up here. What drives the discount rate? Right, the risk of the assets. The risk of your project's assets have to look like the risk of the firm assets. But also on the capital structure side, right? We know that that's what drives firm's discount rate, the mix of debt and equity. So if you're financing a project, if you want to use WACC to evaluate your project, the financing for your project should look like the financing for the rest of the company. Okay, so we said these are pretty tough restrictions. There's lots of cases you can think of where these restrictions aren't going to hold. So what do we do? What do we do if the perfect world where we can use WACC doesn't work? What if our assumptions are violated here? Well, what we need to change the discount rates, right? We need to carefully measure the discount rate, adjusting for all of these things that can drive the discount rate. Okay, we need to take all of that stuff and get a number out of it. That one number is going to be different than the firm WACC. We won't be able to use the company's WACC. We'll have to adjust for this stuff, these drivers of the discount rate, to get a new discount rate if our assumptions are violated. So these are some cases. We've talked about these, but it's all spelled out in the slides here. So if the firm's capital structure changes, well, then you need to change the WACC. Lots of things are going to change. The discount rate on the equity is going to change, for example, because of Modigliani-Miller 2, but also the ratios in the WACC are going to change. So we have to recompute everything. Or suppose you want to compare different companies that have different capital structures. Then we need to put them on an apples to apples basis, right? If you want to compare Pepsi and Coca-Cola, they have the same assets, basically same operations, but maybe they have different capital structures. So how can we compare them? Well, we have to undo the capital structure effect and just get at the assets. Okay, so that's going to mean that we have to do this delevering business and then this relevering. Or suppose you don't have very good data on your company. If your company is private, say, or they just went public, so you can't calculate the beta on the equity, for example. How can you calculate their WACC? How can you get an estimate of their discount rate for their equity discount rate? Well, you could look at firms in the same business, see what their discount rates are, do this delevering and relevering business to learn about your company. Right? Even though you have no data on your company, you can use data on other companies to learn about the company that you're interested in. Okay? That's all possible through this delevering and relevering process. How do we do this? What are the particulars of it? The first step is we're going to get the discount rate for the assets. Once we have the discount rate of the assets, then we're going to adjust for the capital structure. We're going to adjust for these two things, the fact that debt makes equity riskier and that the tax shields are lowering our discount rates. You adjust the discount rate on the assets for the capital structure to get a new discount rate. So delevering, that first step that we're going to do, that's this number one. That's getting at the risk of the assets. And then what's the second step? Well, we need to relever. When we relever, we're adjusting for capital structure effects. Those two steps, once you get the assets, then you adjust for capital structure. Now you can find the new WACC. You can find the weighted average cost of capital for your project, even if your project looks different than the rest of the company, or even if your company changes their discount rate. You can follow these procedures to get the number that you should be using for your discount rate. I'm going to walk through the derivation of this briefly. Don't worry about the derivation. I just want to talk about kind of the algebra. Sometimes it helps to see it in algebra. These are all numbers, but we're going to put it down on paper using our balance sheet identity. So recall the balance sheet identity. The balance sheet is just a way of summarizing firm value. When we studied capital structure, we saw that you can write the value of the company. Suppose it has leverage. We call that VL. This is the value of the company with leverage. We're going to break that into two pieces. We can think about the value of the firm as the value of the unlevered firm, VU, plus the value of all those tax shields, VITS. So we're just breaking the assets, we're breaking the firm value into two pieces. The value of the assets if there was no leverage, and then the value of the tax assets, right? The value of all of those tax savings that are coming from our capital structure. We have the assets now. What does the balance sheet identity tell us? Well, the assets have to equal debt plus equity. The claimants for the company, they own all of those assets. So if you have debt holders and equity holders, you cut up the assets, you give some of it to debt, some of it to equity, it's got to all equal out. So the value of the debt and the value of the equity is driven by the value of the operations and the value of the tax shields. We start with this balance sheet identity, and now we're going to rewrite things in terms of returns. So we've done this a few times now. We've got the value of the operations. That's some fraction of the firm. We have the total value of the firm is VL. Let's just call that V for now, just to get rid of a subscript here. Just the total value of the company is V. And that part of the company, the unlevered component, is earning some return, RU. You can think of this as the return on just the operations themselves, return on the assets. Then we've got the value of the tax shields, again, divided by the total value of the company. And then there's some return on the tax shields. Now this is a little bit weird. We haven't thought much about this. This is the new economic piece for today. We're going to need to think more about this return on the tax shields. What does that mean? Okay, we're going to come back to that and spend a lot more time on this. But for now, just think in the back of your head, there's some risk associated with the company's tax shields. What is that risk? If we can pin that down, then that's gonna help us a lot going forward. All right, so that's the asset side. We have the weighted average return on the operations and the tax shields. Well, that's got to equal the weighted average returns on the debt and the equity. Okay, so we're left with this equation. We're just divvying up returns now. Instead of divvying up the value of the firm, now we're divvying up the returns that the assets get and the returns that the tax shields get split and pay a return to the debt holders and a return to the equity holders. All right. The last thing I'm going to do is I'm going to solve for the discount rate on equity. Okay. I'm just going to rewrite things a little bit to help us see capital structure effects. I want to hone in on the second point that we talked about. We know that discount rates change by capital structure. I want to hone in on that by solving for the discount rate to equity. And again, you don't have to worry about the derivation here, but the math sometimes makes it easier to see the economics. These first terms should look familiar from our Modigliani-Miller notes. The discount rate on the equity starts at the discount rate on the assets, but equity is riskier than debt, so you have to add a premium to that, right? The equity holders are taking more risk because they get paid last. They get paid after the debt holders. So we're adding this Modigliani and Miller 2 term. Right? As more debt goes up, as debt goes up, the discount rate on the equity has to also go up. But we also have to deal with this tax shield piece. And so when we solve for it, we're left with this. We get a third term in our equation. The discount rate on the equity now drops due to the tax shields. Right, we have a minus sign here. The tax shields are good for equity holders. They're a benefit. So that reduces the risk on equity potentially, right? It reduces it by this amount. Okay. So this is just algebra. It's just always true. All it was the balance sheet identity, which is always true, and then a little bit of algebra to solve for the discount rate on equity. But this helps us think about those two capital structure pieces, right? We talked about these two pieces up here. What drives the discount rate? Well, debt makes equity riskier because of M&M2, but then also the interest tax shield shows up. And so we see both of those things here. We see an effect from the, well, actually we see all three things, right? Sorry for scrolling. We have the assets. That's the first thing that drives the discount rates. Then we have the capital structure effect from Modigliani-Miller 2. Then we have the tax shield effect. So we've got these three things, and these three things are all showing up in this discount rate for equity. So we can talk about it kind of in the abstract, or you can just see it in the math, and you can see it in the algebra, and you see each of those three pieces. Now, that's all great. This is just a different way of presenting and showing everything that I talked about up here. But remember what we're after in this class, in this lecture. We want to get a number. So we want to actually pin this thing down. We look down at this equation, and we need to use this. Okay. We need to make it usable. In order to do that, as I foreshadowed, we need to think more about this discount rate on the tax shields. That's a new concept for us. How risky are these tax shields? It's going to depend on what's going on to the capital structure in the future. We haven't talked about the risk of the tax shields. If we can put a number on those things, pin it down, then we can put this equation to work. What's going to drive the risk of the tax shields? It's going to depend on the capital structure evolution. We foreshadowed this above here. What matters is not just, what matters is not just the capital structure today, but also what's going on in the future, right? How is the capital structure changing? That's what's going to determine the risk of our tax shields. We'll talk about this in more detail, but big picture, that's what I want you to have in the back of your head as we go forward, is the discount rate on the tax shields is going to be a function of what's going on to the capital structure in the future. If we can pin that down, then we can use this equation. Okay, and then we can put a number on our discount rates. So all of that math is just explained and worked out in the slides. It's just assets equals debt plus equity. You rewrite it in terms of returns. You set the left-hand side of the balance sheet equal to the right-hand side of the balance sheet. And then we get this, this equation for RE, which is driven by our components, right? All the drivers of the discount rate that we know are shown in that equation. So if we can make reasonable assumptions about the tax shields, if we can say something about those, then we can put a number on the discount rate of equity and see how that changes when our capital structure changes, or when we compare different companies with different capital structures. It's going to depend, again, it's going to depend on how the capital structure evolves over time. Okay, so how does the discount rate on the equity change when we change its capital structure? Again, it depends on RITS, and RITS depends on what's going on to the capital structure over time. So we're going to think about two different models. The first model we're going to consider, and the main one that we're going to use, the baseline, is we're going to consider a firm that keeps a constant debt to value ratio. So when the company grows in value, the company takes on more debt. So you keep that ratio of debt to value the same. We're going to see that if you do that, the risk of the tax shield looks like the risk of the assets. The idea here is that as the assets grow, you have to take on more debt. As you take on more debt, you get more tax shields. And so how risky are the firm's tax shields? Well, they're growing and shrinking with the assets. Okay, that's if you keep the debt to value ratio constant. That's the main model that we're going to focus on today. But I also want to bring up the fact that it depends, right? It depends on what's going on to the capital structure. So suppose you just keep a constant level of debt. Instead of keeping the ratio of debt to firm value constant, now you keep the level of debt constant. Well, then how risky is the tax shield? It doesn't change with the assets anymore. It's just as risky as the debt. And so if you pay off your debt, you get the tax shields. So as long as you pay off the debt, you're going to get the tax shield. So it's not as risky, right? The tax shields aren't as risky as scenario one, where they're now actively growing with the value of the firm or shrinking with the value of the firm. Okay. But big point for now is it depends on what's going on to the capital structure in the future. Now I want to talk more about this first model that we're going to highlight and focus on in this class. We keep a constant debt to equity ratio. That's the same thing as saying constant debt to value ratio. Okay. So our first model is going to have constant debt to equity ratio right here. We're going to study how to delever and relever under this assumption, under a constant capital structure. Okay. Just as a note, because sometimes this confuses students, if your capital structure is constant, if debt over value is constant, then your debt to equity should also be constant. And vice versa. These things mean the same thing. Remember that the value of the company is equal to debt plus equity. And so if the debt to equity is constant, then the debt to value will also be constant. So how can we use this information about the capital structure? How can we use this fact that debt to value is going to stay constant over time? How is that going to help us with our delevering and relevering? Remember, we got to pull up this equation. We have to use this very general equation for the discount rate on equity. This is our very general relevering equation. If we can say something about the tax shields, then we can say something about relevering. Right now, it's hard to use this equation. It's too general. We have too many variables. We need to pin down these tax shields and say what's going on there, and then we'll be able to actually implement this equation. So when we say that debt to value stays constant, that's going to have an implication for the tax shields. Namely, it means that the tax shields are going to grow with the value of the firm. Okay, so let's talk through this piece by piece real quick here. So recall what the interest tax shields are. How much are you saving in taxes because of the debt that you're taking? Well, the tax shield is the level of debt times the interest rate that you're paying on the debt. These two things together give you your interest expense. This is how much you're lowering your income, that lowers your taxable income, which is going to lower your taxes. So you multiply it by your tax rate to figure out how much you're saving in taxes because of the debt. Okay. So what's driving the tax shields is the level of debt. Okay. As your debt goes up, your tax shields go up. As your debt goes down, your tax shields go down. Okay, that's the way to think about this. So how risky are the tax shields then? Well, it depends on what's going on with the debt. Okay. When is the debt going up? When is the debt going down? Well, in our first model, model one, if we have debt to value constant, what does that mean? And this is the key insight. This is going to be the fundamental driver of the tax shields. If the debt to value is constant, then what's driving the debt? The assets. The value of the assets is is what drives the value of the debt, right? If the total value of the company goes up, then in order to keep debt to value constant, you need total amount of debt to go up. Right? So just to illustrate, suppose the value of the company grows. It grows by, say, 3%. Okay, so what does that mean? That means that the value of the company changes into value times 1.03. How can you keep the debt to value ratio constant? Well, you need debt to also grow by 3%. So if you started with debt over value, and then the value grew by 3%, what has to happen to keep that same ratio? Well, you need the debt to grow by 3%, right? You have debt over value, you multiply both the numerator and the denominator by 1.03, that keeps it at DV, right? Keeps it at that original ratio. So what does this mean for the tax shields? Well, it means that the assets are driving the level of debt, and we know that the debt is driving the tax shields. So the full chain of causation looks like this. We have the assets lead to the level of debt, which leads to the interest tax shields. Okay, so putting it all together, as the value of the assets grows, say 10%, the value of the debt has to also grow 10% to keep the debt to value ratio constant. That means that the interest tax shields have to also grow by 10%, because we know that the interest tax shields are just driven by the level of debt. So we're getting this one-for-one relationship between what's going on the asset side and what's going on the tax shield side. Tax shields are growing one-for-one with the asset. So how risky are all those tax shields from the company's perspective? Those tax shields are as risky as the assets. Therefore, the risk of the tax shields is the same as the risk of the operations of the company. When the operations happen to do well, you get more tax shields on top of it. When the operations happen to do poorly, you get less tax shields on top of that. This is going to help us implement our very general relevering equation. What happens if the risk of the tax shields is the same as the risk of the operations? We have this equality that we're going to impose on our general equation. And what you see is that the equation can simplify a lot. In particular, we know that these two things are going to be equal. The rate on the operations is going to equal the rate on the tax shields. So that means that this whole term is 0, and we can just get rid of it. Okay. This is our relevering equation. Oops. We were able to start with a very general equation. We implied some assumptions, we implied something about the capital structure. We said that we're going to have a constant debt to value ratio. That let us simplify our very general equation to something that's going to be workable now. You can look and see what the value of the debt is, what the value of the equity is. You can estimate what the discount rate on the assets are and the discount rate on the debt. And so you can put all that together to estimate the discount rate on the equity. Okay. Likewise, if you wanted to solve this for the discount rate on the assets, we can do that. It actually works out to be very simple. It's something called the pre-tax WACC. And so these are going to be the two equations that we're going to primarily use when we're delevering and relevering. We're going to delever the assets of the company using the pre-tax WACC, and we're going to relever to whatever capital structure we want using this relevering equation. So in the slides, we're just walking through the logic, everything we discussed, but big picture, we have the following chain of causation down here. If you keep the debt to value ratio constant, then the assets drive the level of debt, which means that the assets are driving the tax shields, which means that the tax shields are growing and shrinking with the assets. So the risk of the tax shields is the risk of the assets. That lets us lets us simplify this very general equation into something very simple so that we can study the discount rate on the equity and the discount rate on the assets. For delevering, that's generally going to be the first step in these problems. So I'll put that up before the relevering equation here. What we're going to do is we're going to look at comparable companies to figure out what's going on with their assets. We're going to delever other companies using this delevering equation. That's going to give us the discount rate on the assets of those companies. And if our company has the same assets, then we can use that. So first thing, you get the return on the assets, and then you plug that into your relevering equation. So you know that your company is going to have a different capital structure than these other companies. So you have to adjust for all the capital structure effects on the discount rates. But once you have the discount rate on the assets and you know what your capital structure is, then you can figure out what the discount rate on your equity is going to be. We can do the same things with betas. So if you look at these equations, you can just spell out CAPM, for example. So if we have this delevering equation, let's rewrite everything in terms of CAPM. What is the return on the assets? Well, according to CAPM, it's going to be the risk-free rate plus the beta on the assets times market risk premium. Okay. That's got to equal to debt over value times the return on the debt. Well, what is the return on the debt according to CAPM? Well, it's the risk-free rate plus the beta on the debt times the market risk premium. And what about equity? We have the return on equity. Well, according to the CAPM, what's the return on equity? It's the risk-free rate plus the beta of the equity times the market risk premium. So all I did was I took this delevering equation and I just put in the CAPM equation in its place using betas instead of the rates. And what you'll see is that all these risk-free rates cancel out. We have a risk-free rate on the left-hand side here. We've got D over V times the risk-free rate here, and we have E over V times the risk-free rate here. So if you add up D over V times the risk-free rate plus E over V times the risk-free rate, you're left with the risk-free rate. D plus E is equal to V, so you're left with D plus E over V, which is just 1 times the risk-free rate. So these things are all going to cancel out. All these risk-free rates, we can just kind of drop them from our equation. And then how about the market risk premium? Well, we have a market risk premium here, market risk premium there, market risk premium there. So there's every term is multiplied by this market risk premium. So it just cancels out. We can pull it out of each term. And we're left with our delevering equation where we simply replace the returns with the betas. Okay. This also works for the relevering equation, right? It's the same equation. Instead of writing the relevering equation in terms of returns, you can do it with betas. It's the same exact thing. That's useful because when we estimate beta, there are some data issues that show up. We saw this in risk and return. We have to make certain choices whenever we estimate a company's beta. You have to choose, for example, am I going to use daily data? Am I going to use weekly data or monthly data? You know, we use monthly data. Sometimes you may use other frequencies. You also have to choose the time frame. Should I use 5 years worth of data, 2 years, 6 months, whatever? And the number that you get when you estimate the beta can depend on the method that you use. Okay. Or you may just have noisy stocks. If your stock price is very volatile and it's moving around a lot, then you may not have enough statistical power to estimate the beta very precisely. Right? There may be kind of specific stock price movements or illiquidity things. If it's hard to trade a stock, you may get kind of big movements that aren't driven by the risk of the company, but are just, it's hard to trade that stock, and so you get big movements. And then finally, if you're thinking about private companies, take it to an extreme. Take it to an extreme case of illiquidity. If a company is private, you can't trade it at all, and so you can't estimate its beta. Right? You don't know what the beta for their equity is because it's not public. Fortunately, we can use this delevering and relevering insight to get a beta for our companies. Even if we have bad data or no data for the company that we're interested in, we can delever other companies in the same industry. We can see what their betas are, and we can delever those betas to learn about our beta. So that's all summarized here. Instead of relying on just our one stock, we can look at comparable companies in the same industry. We can estimate a bunch of betas for all of these comparable companies, and then take the average to get a better sense of what our beta should be. Okay. And that's going to get rid of all of these statistical issues that make it hard to deal with the data. Once you get the beta on the assets of all of these comparable companies, then you recognize, well, those companies have different capital structure than us. We calculate the assets, we need to relever to our capital structure, and so we can infer what the beta of our equity should be by using our relevering equation. Okay. So that's the theory. That's we need to make some assumption about our capital structure. We need to have something, we need to say something about what's happening to our capital structure in the future. In this first model, we're saying that the capital structure is going to stay constant. You're going to have a constant debt to equity ratio. That lets us simplify a very general equation. It's very general, but not very useful, but we can simplify that into something that is useful. Right? And we can actually put numbers in here and get a discount rate, get a number for the discount rate on our assets, and likewise get a number on the discount rate for our equity. So I'm going to do some examples, hopefully take this abstract concept and make it more concrete. In both of these examples, we're going to stick with this model. We're going to keep a constant capital structure. So debt to value is going to stay constant over time. And as we saw, that implies that the discount rate on the tax shields is the same thing as the discount rate on the assets. That's going to give us two equations, a delevering equation and a relevering equation. We're going to be able to rewrite this very general equation into a delevering equation here and a relevering equation here. In the first case, the company is going to change their capital structure. They started off with a debt to equity ratio of 2/3. We learn about what their capital structure used to be. It used to have a cost of equity of 14%, cost of debt of 5.6%, and a tax rate of 35%. And then we have some CAPM information. The risk-free rate is 5, and the market risk premium is 6. Okay, so that's all what it used to look like. We're considering a change in the capital structure. Okay, so same company, we're just going to change things once. The firm is thinking about repurchasing the stock, and how's it going to do that? It's going to issue debt. So you take out a loan, you use that money to buy back some stock from your equity holders. Okay, so you're shifting your capital structure toward debt. You're taking on a bigger loan to shrink the size of your equity. So your debt to equity ratio used to be 2/3, but now it's going to go to 3/2. Assume that the company's going to maintain this ratio forever going forward. Okay, so what does that mean? What does that give us? Well, that tells us that's a key word, that the debt to value ratio is going to stay constant. Right? We needed that line. We needed that line to know that the discount rate on the tax shields is going to be the same as the discount rate on the assets, which means that we can use these two equations. And so that's just a signal to you, right? It should cause you to recognize that these are the equations that we're going to use. Okay. First question is to find the discount rate for the operations of the company. That's delevering, right? Find the discount rate on the assets. Then we're going to find the firm's new cost of equity. Okay, well, what is that? That's relevering. We're going to find the discount rate on the equity once we know the discount rate on the assets. Then we can think about the beta. How does the beta change before and after the capital structure? Now that's not really new for today. The new parts for today are these first two subpoints, delevering and relevering. Once we have that, then we can think through what's going on with the beta. We'll see how the beta changes, and then we'll see how the WACC changes as well. Once we know what's going on with the equity, we can see how the WACC changes. So question 1, find RU. That's the discount rate on the operations. We forget about capital structure and just focus on the operations. Well, what are we going to do to get that? Well, it's the delevering equation, the pre-tax WACC. Which company are we going to, what are we going to delever? We're going to delever using the data that we have available. We have information on what the company used to look like, right, before they did this swap. We know what their debt to equity ratio used to be. We know what their cost of equity used to be and their cost of debt. We're going to use this information to find out what's going on with the assets. We don't know what the cost of equity is going to be after we restructure, so we can't use the pre-tax WACC after the restructuring because we don't know what this thing's going to be due to all these capital structure effects. We know what it was before we restructured the debt, so that's the data we have. That's what we're going to use to get the discount rate on the assets. So how much debt did the company have? Just walking through this equation now, we're going to delever the company. We need to know the debt to value for the company originally. We see that the company had a debt to equity ratio of 2/3. So what does this mean in words? It means that if you split the company up into pieces, there's going to be 2 pieces of debt and 3 pieces of equity. Right? For every 2 pieces of debt, you have 3 other pieces of equity. So what does that tell us about debt to value, right? That's what shows up in the formula, debt over value. Well, if the total value is debt plus equity, then you can think about this as being like 2 plus 5. There's kind of 7, or 2 plus 3, excuse me. There's 5 total pieces, 2 pieces in debt, 3 pieces in equity. So you can think about it being, well, there's kind of 5 pieces of the company that we've cut up. So what's the debt over value? Well, the debt is 2 of those pieces. It's 2 pieces of debt, 3 pieces of equity. So the debt over the total value is going to be the 2 pieces of debt over the total of 5 pieces. Okay, so we have a 2/5 debt to value ratio. What was the cost of debt? Just working left to right through the pre-tax WACC now. We have debt over value. What is the discount rate on the debt? Well, in the first bullet point, we saw that that was 5.6%. We multiply the debt ratio times the discount rate on the debt. What about equity over value? Well, if the company was 2/5 in debt, then 3/5 of the company is in equity. And what was the discount rate on the equity? Well, it was 14%. So you put all this together to get the discount rate on the assets. This works out to about 10.6%. That's it. That was the first question. What is the discount rate for the operations? We just had to work through the pre-tax WACC. The only kind of tricky part is that we had to use the information from before the restructuring, right? We had all this information on what the company used to look like. We had to use that information to figure out what's going on with the assets. If you tried to use the new debt to equity ratio, you're going to get stuck, because you know that once the company changes its debt to equity ratio, it's also going to be changing its discount rate on the equity. And so you can't use that information now. To get at the assets, you have to use the kind of the previous capital structure. Okay. So that's question one. Then question two is relevering. And as you can see the pattern now, we delever to get the asset return. Now we're going to relever to get the new cost of equity after we change the capital structure. We're going to use the relevering equation here. So we need to find the discount rate on the assets. Well, we just did that. That was the 10.6 from the delevering step, right? That's the whole reason we did the delevering, is to get the discount rate on the assets. So now we can plug that in to the relevering equation. What's going to be the new debt to equity ratio? Well, it's going to change to 3/2 now. It used to be 2/3, now it's going to be 3/2. So we're going to use that 3/2 in the relevering equation to the new capital structure. All we did was we worked left to right through the relevering equation. We found that RU is 10.6, then debt to equity goes to 3/2, and the discount rate on the debt, we said that that stays the same. So we put all this together to get the new discount rate on the equity as 18.2%. And that's it. Those were the new ideas for today. We had to delever to find out what's going on with the assets, then we relevered to the new capital structure, and that's it. These third and fourth questions here, finding the equity beta and finding the WACC before and after, this is just review. So it's good to do. We'll practice some more, but there's nothing new about this for today. So let's move on to question 3. Find the equity beta before and after the restructuring. Well, we know if we're talking about betas, then we're talking about CAPM. So we know that we're going to be working with this CAPM equation. What used to be the discount rate on the equity? We know that it used to be 14%. That was given in the top bullet point. So we can solve for the discount rate, or we can solve for the beta on the equity. If we know that the risk-free rate is 5, and we know that the market risk premium is 6, we can solve for what the beta used to be on the equity. We'll get 14 minus 5 is 9, divided by 6, we get 1.5. And we can do the same exact thing for the new equity, right? Once we restructure the company, we know that the equity gets riskier. When we take on new debt, the equity gets riskier, so the beta is going to change. What is the new discount rate on the equity? Well, we solved that in part 2. We relevered to the new capital structure to get 18.2 instead of the 14. So now we have 18.2 is equal to 5 plus the beta times 6. You work through that and you'll get that the new equity beta is 2.2. So this is worth seeing. This is worth pointing out. The beta went up when we took on more debt. Right? You take on more debts, now you basically took on a greater fixed cost. You have to pay the bank whether times are good or bad. We saw that that's a fundamental driver of beta, those fixed costs, right? You can't, the fixed costs make your cash flows more cyclical because you can't cut back on your costs when times are bad. Debt, you can't cut back on, right? Times are good, times are bad, you have to pay the bank the same amount. So you can't cut back on that. That means that what's left over for the equity holders gets more cyclical, becomes more systematically risky. That should show up in the beta. And in fact, it does, right? The beta for the equity has to go up from 1.5 to 2.2. And then the last sub question here is find the WACC before and after. So we know that the WACC is debt over value times RD times 1 minus T plus equity over value times RE. So what did the WACC used to be? Well, what was the old debt to value ratio? If we had a debt to equity of 2/3, then it used to be 2/5 debt. We had a 5.6 cost of debt, tax rate of 35%. We had 3/5 of the company in equity, and we were earning a return of 14% on the equity. So you just plug all that into your calculator, you get the WACC used to be about 9.86%. So call it 9.9%. How did this change with the new capital structure? Well, what's the new debt to value ratio? Well, now it's going to be 3/5 instead of 2/5. The discount rate on the debt, it didn't change. We didn't have any indication of that. But the discount rate on the equity did change. Right? The discount rate on the equity jumped up to 18.2. So the total WACC, therefore, has dropped. It went to about 9.5. Okay, so a couple points here. A common mistake is to just change the weights. You can't forget about the discount rate on the equity. When you change your capital structure, we know from Modigliani-Miller 2 and the rest of the capital structure slides, we know that the discount rate on the equity has to change. And so you can't forget about that. That's someone's going to make that mistake. We should have at least 3 things change. Debt to value changes from 2/5 to 3/5. Equity to value changes from 3/5 to 2/5. And then the discount rate on the equity changes from 14 to 18.2. Right? You should have at least those 3 things changing. Economically, does this make sense? Does it make sense that the WACC dropped from 9.9 to 9.5? Well, it should. What are we getting now that we weren't getting before? When we take on more debt, we're getting more of those tax shields. That makes projects look better. You take a mediocre project and at least you get the tax savings from it. And so you wouldn't have taken it if you couldn't get the tax breaks. But if you can get the tax breaks on top of it, then you may start to be interested in it, right? You may take projects that otherwise look mediocre. Now they start to look good because you get the tax shields. Okay, so that's going to effectively lower our discount rate. It's lowering our WACC. We're going to take projects with lower returns. Okay, that's all represented in the drop from the weighted average cost of capital. Okay, so this is all the work here, small prints. We have this note here, 2 things change, the ratios as well as the discount rate on the equity. in general, this drop in the WACC is always going to be true when you increase your capital structure because of the tax shields, right? The only thing that the WACC is picking up are the tax shields. More tax shields are good, less tax shields are bad. So more tax shields drops your discount rate. Now, in real life, we'll talk about that at the very end of this class, that there are trade-offs. Obviously, you don't want to take on too much debt that you go into bankruptcy, and that causes lots of problems. But for now, all we're considering is taxes, and more debt is better for your tax situation. It's also important to recognize this relationship here. The discount rate on the WACC is going to be lower than the discount rate on the assets, and the discount rate on your assets is going to be lower than the discount rate for your equity. Okay, so this is, again, generally always true. What's going on with the WACC is that you're getting tax shields here. The discount rate on your assets, that's just the discount rate for your operations. That's what your operations are going to need to earn. But those don't include your tax shields. The WACC is including the tax shields, and that's why it's pushing the discount rate down. You're getting an extra benefit from the tax shields, and so your required return is lower. So the return on the weighted average cost of capital is going to be lower than the return on the assets because of the tax shields. And then we know from Modigliani, Miller, and capital structure that the discount rate on the equity is the highest. The risk of the equity is higher than the risk of the assets because the debt doesn't take risk. They don't take very much risk. And so if you cut up the assets into debt and equity, and the debt doesn't take the risk, then all the asset risk has to get squeezed into the equity component. And so their required return goes up. Okay. So we're always going to see this relationship where the WACC is lower than the rate on the assets, which is lower than the discount rate for the equity. Let's do another example. Again, we're going to stay in this world where debt to value is constant. That means that the tax shield is going to have the same discount rate as the assets, which means we're going to have these two formulas. We're going to just apply these over and over again. Okay, so I'm going to drop those notes and work on question 2. This one's a little bit different. In the first example, we had the same company, but we changed the capital structure. So where did the discount rate on the assets come from? Well, we used the data that we had before the restructuring. So we were still using the same company, but we had information before the restructuring, and then we used that information to learn about what happened to the company after the restructuring. You can do something similar by looking at different companies. So suppose you've got 2 companies that are in the same business. I can learn from one company about the assets of the other company, and I can use that to figure out the WACC of this second company. Right? It's analogous to learning about the old company before the restructuring to help us think about the new company after the restructuring. We're learning about some other company with a different capital structure. We're learning about the assets from that other company and then using that to learn about the company that we really care about. Okay, the steps, the mechanics are going to be the same. We're going to go through these same exact steps. You're trying to value a company called AMR. Now it's newly public. So that means that you don't have very much information on their stock, right? You can't estimate a beta if you don't have very much stock data. We have some information on how many shares are outstanding, 10 million shares outstanding, and you estimate their free cash flows are going to be $10 million next year, and you expect that the free cash flows are going to grow at 4% in perpetuity. You also know their debt to equity ratio is 1/3, and you expect that to remain stable. So again, this is the flag. This is my signal to you. If debt to value is constant, then that means we can use these equations. Okay, so you should always see that in these type of problems. Okay. So the debt to equity ratio is constant, and we have the debt beta of 0.1. Now, the problem is that the firm has only been listed for a short period of time, so we can't estimate the beta on the equity. We have to use something else. We have to use this other company, UAL. That's going to help us learn about AMR. Okay. So you have a lot of information on UAL. You know that they're in the same industry with the same operations. You see the beta on their equity, the beta on their debt, and their debt to equity ratio. Okay, so we're going to use that to learn about AMR. We have a risk-free rate of 5, market risk premium of 6. So this is all CAPM. We're going to be using CAPM. And we have a tax rate of 40%. Okay. questions. What is AMR's cost of equity and their WACC? And then what is their enterprise value and equity value and share price? Right? So the first part is the new part. We need to find AMR's cost of equity. That's the new thing. Now the rest is kind of, once we have that, the rest is review, right? Find the WACC, find the enterprise value, equity value, share price. That's all review. But the new thing is to find their cost of equity. How are we going to do this? Well, we have to delever something, right? That's the first step. Is we're going to delever, and then we're going to relever to get the cost of equity that we care about, right? We care about AMR's cost of equity. That's right. That's the first thing that we're after. But we can't get this thing unless we know what's going on with their assets. Okay, I don't know what's going on with AMR's assets, so I can't figure out what's going on with their equity. What information do we have about their assets? Well, we know a lot about this competitor company, UAL. So we're going to delever UAL to learn about AMR's assets. Delever UAL. We have a lot of information on UAL. We know what their debt to equity ratio is, their betas, so we can infer what's going on with the assets. We have the betas here, so I'm just going to use the delevering equation with betas. Remember, if you can delever with returns, you can just replace all of the returns with betas. So that's what I'm going to do just to save a step here. I forgot to do it. Okay. UAL has debt to equity of 1. That means that their debt to value is 1/2. Okay. So 1 part debt for 1 part equity means that it's 1 part debt for 2 total parts. So debt over value is 1/2. The beta on their debt is 0.3. It's 1/2 equity. The beta on the equity is 1.7. So you plug this into your calculator and you get a beta of 1. That's the beta on the assets. So therefore, the return on the assets, just applying CAPM, is going to be 5 plus 1 times 6, which is 11%. Okay. We know that the risk-free rate is 5, the market risk premium is 6, and if the beta is 1, then we get a return of 11%. Why did that help us? Why did we go through all this business with the UAL? The key insight is that the operations are the same for these two companies. So if we can learn about UAL's operations, that tells us something about AMR's operations. Right? AMR's assets are the same. So if UAL's discount rate for their assets is 11%, that's the return on the unlevered firm, then that's also RU for AMR. That brings us to the second step, relevering. Once we know RU for AMR, we can figure out what their discount rate is on their equity. Okay. So the discount rates for AMR's equity is going to be the discount rate on their assets. Just walking through the relevering equation up here, we found that the discount rate on their assets is 11% from step 1. What's AMR's debt over equity going to be? Well, they have a debt to equity of 1/3. That's just given to us. So we just plug that straight into the formula. Discount rate on the assets is 11. And we have to subtract the discount rate on AMR's debt. So what's the discount rate on AMR's debt? Well, it doesn't tell us exactly, but it tells us that the debt beta is 0.1. Okay. So we're going to use that to calculate the discount rate on their debt. So real quick, just as a review, using the CAPM, we have the risk-free rate on the debt, or the risk-free rate is 5 plus the beta on the debt is 0.1 times the market risk premium of 6. So we get 5.6% for their debt. Okay, this is just the CAPM, knowing that the beta is 0.1. So we put all that together and get the discount rate on the equity for AMR. It works out to 12.8%. So that's the new stuff for today. We delevered the company that we had access to. We had data for UAL, so we delevered that to get the discount rate on their assets. And then we applied that to AMR, the company that we were interested in, really. We applied the relevering formula to get the expected return on their equity, 12.8%. This is very helpful because we had no data on AMR, right? They were newly public. You didn't see what was going on with their equity. But we can use some other company that has similar operations and infer what should be going on with AMR's equity. So you can see how this opens up a lot of avenues for us. It gives us a lot more data to work with when we're trying to estimate our discount rates. That's the new stuff. The rest, I'm going to go through this problem just to see how it all fits together with kind of a typical stock valuation problem. But the rest should be review, right? The rest, what we're going to do is we're going to calculate AMR's WACC, then we're going to calculate their enterprise value and their equity value. Nothing new for today, but it's kind of useful to see the big picture, how all of these pieces that we've been talking about fit together. So what is the AMR for WACC, or the AMR's WACC? If they have a debt to equity ratio of 1/3, then their debt to value is 1/4. Right? If it's 1 part debt for 3 parts equity, then it's 1/4 debt. The discount rate on their debt is 5.6%. We just figured that out up here. And we're given a tax rate of 40%. What is equity over value? Well, if debt is 1/4, then equity is 3/4. And then we have the discount rate on their equity of 12.8%. So you put all that together to get their weighted average cost of capital. That gives us 10.4%. So that's a good review of the WACC. The next thing is to find AMR's enterprise value. And again, this is a good review. What do we do with this WACC once we have it? Just as a reminder from our WACC notes. We're going to discount the free cash flows for the company by the WACC, and that's going to give us the enterprise value, the value of everything. It's going to give us the tax shields as well as the value of the operations themselves. Okay. So what's going on with the free cash flows? And we have to figure out what's going on with the free cash flows, discount those by the WACC. It's going to generate free cash flows of $15 million next year, and that's going to grow at 4% in perpetuity. Okay, so it's a very simple growing perpetuity problem. The enterprise value for AMR is going to be just a growing perpetuity. So we have free cash flow that occurs at time 1. You discount that by the WACC minus the growth in the free cash flows. So we have 15 divided by 10.4 minus the growth rate of 4. Hence, the enterprise value is going to be about 234 million. Okay, so that's a good review there. And then we can do what an equity analyst would do. If you know what the free cash flows are and you value them using the WACC, what does the equity analyst trying to do? What are they trying to sell? Well, they're trying to sell kind of advice to their clients. They want to get the share price, and they want to say, what is the correct share price for this company? We're going to use that, the enterprise value, to figure out what the equity value is for AMR, and then work out the share price from there. Okay, so if the enterprise value is 234, what is the value of the equity? We know that the debt to equity ratio is 1/3. So we said that 3/4 of the company is in equity. If there's 4 total parts for the full firm, 3 parts of those are in equity. So we can take 3/4 of the enterprise value to get the value of equity. We know that the total value of debt and equity is 234. So 3/4 of that goes to the equity holders. That means that all the equity is worth about $175 million. So if there's a total of $175 million in equity, we divide that by the number of shares to get the share price. We see that there's 10 million shares outstanding. So therefore, the share price should be about $17.5. Okay, so the analyst would go through this and say, look, this is a newly public company. We don't have much data on it, but it should be worth $17.5. And so they would sell this advice to their clients and say, if you see the stock trading at more than 17.5, it's overvalued. If it's trading at less than 17.5, it's undervalued. And it's kind of interesting. How do you get this number? How can you get this number when it's newly public, right? Well, you have to go through all of this business, right? You have to figure out what their discount rate is going to be by looking at other companies with the same assets. And then on top of that, you forecast their free cash flows. You discount those free cash flows by your kind of the WACC that you figured out using other companies to get the enterprise value, and then you infer what the value of the equity should be. Okay, so you can see how everything that we've talked about in this class kind of fits together. We've used stock valuation here. We've used the growing perpetuity formula. We used the WACC. We used our delevering and relevering for today. So everything just feeds into one another. And just to remind ourselves, this process has opened up a lot of data for us. We see that this delevering and relevering technique can give us information for private firms and other non-traded assets like individual divisions within a company. You don't have stock data on those individual divisions, but you can still learn a lot about those divisions through this delevering and relevering process. Next, we're going to talk about a second model. So remember, everything we've done so far is assuming that debt to value is going to stay constant over time. That gives us a result on the tax shields. We know how risky the tax shields are because of that. Well, if the capital structure looks different over time, then we're going to have a different implication for the tax shields. Now we're going to move to the second scenario. Instead of having debt to value stay constant, we're going to have a constant debt over time. That's going to change all of the delevering and the relevering business. So we're going to get rid of all of these things that we've had. If the debt stays constant over time, then what's going on to the tax shields? Well, the tax shields are just tied to the debt. We know interest tax shields are equal to debt times the interest rate times the tax rate. But if the tax shields aren't moving with the assets and they're just stuck to the debt, then the risk of the tax shields is just the risk of the debt. The intuition here is that as long as you don't default, you get the tax shields. So the risk of the tax shields is the risk of the debt. This is different than what we saw before. Before, the tax shields were growing and shrinking with the assets of the company. So it was actually riskier. It was much riskier than the debt, because when the company does well, you get more tax shields. There's nothing like that going on here. If you just have a constant level of debt, then those tax shields aren't very risky. It's just as long as you don't default, you'll get the tax shields. Okay, so we've moved into the second scenario. How does that affect our delevering and our relevering? Well, we start with this very general equation, as always. And now what we're going to do is we're going to substitute the discount rate on the debt for the discount rate on the tax shields. Okay. So we have that substitution here, and then what we'll do is we'll combine this term with that term. It's the same thing, right? The discount rate on the assets is the same thing as the discount rate on the debt. Those two things are the same, and likewise the denominator is the same. And so we're left with the following. This is still a little hard to use, though, because we have this value of the tax shields. We have to know up front how valuable are those tax shields. Well, with this constant debt model, that means that the tax shields are a perpetuity. Okay, it's a very stylized example. Okay, so we'll talk about this. We're not going to kind of use this model in real life, but it's just worth as a thought experiment, really. But if debt is constant, then the interest tax shields are going to look like a perpetuity. Interest tax shield is going to be the debt times the interest rates, RD, times the tax rate. And if that's a perpetuity, then we can value it using the perpetuity formula. Here, so the tax rate is going to be the level of debt times RD times your tax rate divided by RD. Because the discount rate on the tax shields is the discount rate on the debt. So what are we left with here? We're left with just debt times T. Right? We have RD in the numerator, RD in the denominator. So the value of the tax shields is just debt times T. So that becomes debt times T. We can rewrite this as debt times 1 minus T. That becomes our new relevering equation. It's a very stylized example. So again, don't worry about this equation. We're not going to practically use this equation. It's just to give us an idea of how the relevering depends on what's going on with the tax shields. It depends on what's going on with your capital structure. This is one simplified example to see that. Okay. That also means that the delevering equation is going to look different. I'm not even going to solve it because it's a mess here. But if you have this relevering equation, which we just derived, and then you solve for RU to get the delevering equation, you get this kind of mess. Okay. So the punchline is the mechanics for delevering and relevering depends on what's going on with the tax shields. It depends on what's going on with the capital structure. Things are very nice and clean if you keep a constant debt to value ratio. Things get kind of messy and not very usable if you deviate from that. Okay, so we're not going to, practically, we're not going to deviate from our first model. We're going to keep this debt to value ratio constant, but it's worth talking about what happens if that's not true. Okay. So to conclude, which model are we going to use? Model 1 versus Model 2, right? These are our two models. We're going to stick with Model 1. For all intents and purposes, we're going to have firms that have constant debt to value ratios. That's going to give us very nice formulas for delevering and relevering the companies. Okay. It's also what most practitioners are using. For big firms, for investment grade firms, stable companies, it's going to be a pretty good assumption. For companies that are not stable, or companies that have a probability of default, for example, then it's not going to work. We'll need something else. We'll need some other tool to think about discount rates. We're not there yet. What did we learn from Model 2? Why did we go through this whole business? Well, the point is that the mechanics for delevering and relevering depend on the evolution of capital structure, right? Depends on what you think is going to happen to the firm going forward. And it can look a lot different, right? It can be simple. If D over V is constant, it's going to be not simple otherwise. Okay. So we'll need a new method if debt over value is not constant. If you have a company that has a threat of bankruptcy, for example, we'll need something else. We're going to call that APV, the adjusted present value method. We'll talk about that next class. But for now, you just should know that there is a limitation here. We can't do all of this delevering and relevering if the capital structure is not stable. To conclude, the cost of equity and its beta depend on both the assets of the company, right, the operations, that's RU, as well as the capital structure. Okay. And it's not just the capital structure today, but it's the capital structure going forward. The capital structure comes into play when we think about Modigliani-Miller number 2, right? More debt makes equity riskier, but also through the tax shields. Tax shields can affect what's going on with the equity holders. So we need to account for all of that stuff when we're thinking through a company's discount rates. We have this pretty nice two-step procedure where we delever the assets to get at this first bullet point, right? We want to get at the risk of the operations. That's why we delever stuff. We delever the company that we have information for. Maybe it's the company before the restructuring. Maybe it's a competitor company. The whole delevering business lets us learn about the assets. Then we adjust for the second point, the capital structure, by relevering. We talked about a bunch of different contexts where this helps us. The first example we did had a company that changed their capital structure. So we can see how the discount rate on the equity changes when a company changes their capital structure. We can think about estimating discount rates for private companies. You don't have very much data here, but you can look at public firms that are doing the same kind of thing and learn about their assets to learn about your private company's assets. And finally, we talked about improving beta estimates. Anytime you estimate a beta using stock price data, it's going to be a little bit noisy and it's going to be a little bit arbitrary. You have to make certain assumptions along the way. It's helpful to have more data. And if you can use other comparable companies to improve your estimates of beta, that's helpful. And that's what this delevering and relevering business gives you.